welcome. Patriot Radio News Hour, Joe and Jason on this Tuesday. I hope it finds you well out there. Our toll-free number, 800-951-0592. The website at allamericangold.com. And, Jason, it is Tuesday. I want to say tomorrow, I think we're going to get our inflation report out. I have confirmed there is going to be a change in the formula when it comes to health care that is going to be adding some extra, some extra inflation to the number, to the core number. And really all that means is, inflation has been worse than what we've been telling you, especially when it comes to health care, and we're going to update that. Here's the thing that I'm wondering. Is this the number was going to go higher anyway? So let's just say, we're doing this. And then that way, when the number gets higher, somehow it'll still be lower than what the expectation was. In other words, we're going to tell you healthcare is going to add a half a point to inflation in tomorrow's number. And then when it only comes in at 0.4, right, they can say, it really isn't that bad because most of this was just this healthcare thing. That's how my mind's working right now.
Well, okay, you're speaking a scenario where they raise the rates again. Is what you're doing. You're talking a way of rigging it to have a higher rate.
They're not going to do it. I guess this is how they're not going to. Yes, it got hotter, but it really.
Oh, that's right. Right. I got it backwards. You know, I got it backwards. Yeah, if you calm it down, freeze the rates. You're right. Exactly. Okay, Joe.
Scare everybody before it happens, and then when it goes up, but not as much as they were expecting, they can say, I guess Jay Powell can still not raise. That's my guess.
We'll see, Joe. Right. To me, the CPI, that's tomorrow, right? We're looking at the CPI.
Yeah.
And, I was looking at that. I was going to mention it yesterday, but the drop-offs in 2022, it goes from 8.5 in July to 3.2. So 2 months ago, we went 3.0 to 3.2. It went up a little bit. The drop-offs for the next 2 months aren't very much. So if CPI is frozen or doesn't go down, this is very bad because starting with October, November, December, you have 0.6 drop-offs from 2022. If you don't see inflation going way down at the end of the year, anything staying where it's at or going up is complete inflative problems, and they'll be raising rates at the end of the year, Joe. It's got to drop. There are 2% that they're talking about getting. If they don't get that by the end of this year, there will be rate hikes. There will be.
Well, and people are out there, and again, I saw it again today, right? These wishful thinkers that the Fed is done raising rates, or they're going to raise in the next meeting, the October meeting, but then that's going to be it. I don't know. We'll see. I got a funny feeling about tomorrow's number, but we got to talk, and I hate to do it, but we have to do it. Crude oil on a rocket ship again this morning, now approaching $90 a barrel, 89.15, 89.20. Brent crude, 91 and a quarter. Unleaded gas continuing to, natural gas, all of it heading higher as the OPEC cuts seems to be having a big issue as far as the supply of oil coming out is even less than what people were expecting, driving oil prices even higher today. And Jason, just like on cue, you were talking yesterday, I saw a bunch of $100+ oil calls this morning. We're seeing 120, 125. Go back a year ago or so. Oil got to like 109. So are we setting up for oil to go back that high again? We'll wait and see. But again, it's about inventories. These are, and they seem to be doing this in a ton of things. This is why we tell everybody look out for silver, right? Because we know what the inventory levels are, historically low levels. They're doing the same thing in all the commodities. They're doing it in oil. They're doing it in corn. They're doing it in soybean. They're doing it in wheat. And you know, Jason, you know, this scarcity thing driving the world inflation. And most of it self-inflicted, right? They just, the Biden administration the other day, out of the blue, well, we're just going to cancel all of these oil leases that we originally, you know, the Trump administration had given out. It's almost deliberate, isn't it?
Yeah, you know, and we played that little piece of Joe Brown, kind of timing it. It was on the Half Empty Cup of Joe, I think Friday, but kind of saying 6 months. Which, you know, just for stuff that's unrelated, but I always tend to look at these things, you know, with all the emergencies that have gone on, and let's just go with COVID, the NFL football season never seems to be interrupted. All the games get in, the Super Bowl is played, so it's funny how these things are happening right at this moment. It sure seems like whatever emergency is getting ready to happen, whether it's economic or something else, you know, the football season starts. There's only 4 months now, and then the football season's over. And they can emergency can commence. Isn't it interesting how they just always time it? The NFL is their biggest propaganda arm as far as they want to get information out there because there's still large audiences watching football. So I always find that funny. You know, everything got closed down during COVID, but the Super Bowl was still played and all the games were played. NCAA tournament, that doesn't matter.
Yeah, right. We can get rid of that one. Since you brought it up, how soon until the economy's like Aaron Rodgers, right? The life was going to be great for the Jets. 4 plays into it, yeah, you're done for the year, right? So I got a funny feeling we're closing in on being done for the year here really, really quickly. Patriot Radio News Hour, Joe and Jason. We'll be right back. (800-951-0592) Patriot Radio News Hour. Joe and Jason on this Tuesday, waiting for tomorrow's CPI number. So they're letting the cat out of the bag. Hey, that they think CPI is going to be hotter because of this adjustment, paving the way. I'm confident we're going to get a higher number. I think it's going to be significantly higher number, but somehow it'll be less than expectations. I still actually believe, even no matter what the number is tomorrow, I don't know that the Fed really is going to raise rates next Wednesday. So the Fed next Wednesday will let us know. I don't think it matters. I think this is how stubborn these guys are. This is how stubborn they are. Well, we started this every other thing, you know, a few months back. So we paused for a month and then raised. They haven't sent enough signals to me that they're going to do something different. The market still expects a pause. And for right now, I think that's probably what we're going to have. And I'll call it a tough pause. I think what they'll do is, hey, we didn't raise, but more than likely we're going to raise it at the next meeting. That's kind of what I'm expecting. But something interesting to look at here. So we've talked about the small and medium-sized businesses and the struggles that they're going to have. By the way, we got a couple more companies. They didn't even make it to 2024. Struggles with their debt and being able to refinance it. We'll get to that in a minute. But since Labor Day, I've been watching the bond markets, and Wolf Richter does a really good research on this as well. And we're having several bigger companies hitting the bond market, raising capital at what most of us would say, well, gosh, the interest rates are pretty high. You know, everyone's still talking about, well, we're going to cut rates, you know, next year. Why not wait? Why would you lock in now when Wall Street, at least the people on TV, are telling you they're going to be lowering rates next year? I'm not so sure. Because get a load of this. Companies like T-Mobile, Philip Morris, BHP, all of these companies in the last week and a half, Jason, have been tapping the debt markets and saying to their investors, hey, we're doing it now because we actually think the rates are going to go higher next year. In other words, you look at these companies, they're looking at their own costs. And they're saying, BHP Billiton's saying, well, we don't see prices going down, right? I'm sure they're probably looking at oil and electricity, right? Because they're a big miner. Those are important things for them. They're probably looking at the cost of tires and trucks and engines and all that stuff, labor. And you know what they're saying to the markets? We don't think our costs are going to go down next year. T-Mobile. Right? Same thing. Hey, our suppliers are telling us, and we were looking at our subscribers, we kind of have a pulse here. Costs are not going to go down. We know we've got all these stores, leases are costing more, employees cost more. We're tapping the markets now. Philip Morris, they're huge. Philip Morris is huge. They've got products all over the place. And they're saying the same thing, Jason. It really is. This is new. We've seen a lot of companies that have been waiting. And now these are companies, these are not AAA, obviously. Most companies aren't. But these are companies that are 2, maybe 3 notches above junk, right? So these are companies, they're in the low A's, the triple B pluses and the A plus. So these are companies, they're 2 or 3 notches above junk, and they're saying, you know what, we're going to tap the market now because if we wait, it's going to cost us a lot more, and then we may get downgraded because of it, right? And all of a sudden, right, because we had to borrow at such high rates, we're now a junk status type company. It's an interesting development and one that we'll see if this continues, but they're borrowing, and they're borrowing big.
Typically what we'd be looking at from the last couple of decades, even more, is you see a recession happen, and then a little demand destruction comes in, and prices drop because the markets are in bad shape. But we've been how many times on this show, especially, just talking about how often all over the world they're just destroying sources of oil being put into the market. So if you drop the supply and demand market, that's how markets run, no matter how much they manipulate it. But you can manipulate the supply by not giving a supply. So if the supply disappears when the demand destruction hits with a recession, then the prices won't go down. I think a lot of market experts are looking at this that have been done for a long time. If they're not paying attention, they're like, well, we're going to get our market crash, so then the prices will come down. Things will even off. But not if they purposely, any industries purposely not cranking out houses. If they're not cranking out oil, those prices will stay the same. And from what you're saying, Joe, hey, but maybe we better buy into this stuff now because it's either going to be just as expensive or more. When the rate hikes stop, which I think will happen, I don't see them going down, Joe. I see the rate hikes. I mean, they've been going up for 2 years. I don't see where they would just drop them in 1 year. Maybe with a market crash, maybe. But I still say a year of keeping rates flat as a wait and see. That's going to be 2024, Joe.
Yeah, and these companies are locking in the average about 6%. So, think about a 10-year note right now at 4.3, locking in at 6%. To give you an idea of what this is, we had 20 investment-grade companies issue debt on the Tuesday after Labor Day. So this is something where and it's a wide breadth. When you think about the companies that were in, it wasn't like, it was just the telecom space. Right? It was telecom. It was mining. It was retail. It was manufacturers. I mean, it literally ran the gambit here. And just to give you an idea of the difference in cost from when they were doing the 10-year note, they're saying that it's about 34% higher, the cost, than it was in September. of 2022 as far as the number of companies saying we need to borrow now. And you would think in September of 2022, they knew rates were still going higher, Jason. I mean, they knew that. They knew, hey, a year from now it's going to cost us more money. Everyone knew that. And yet this year it's 34% higher.
Well, and once again, from what I've been looking at, it's very possible that when the reverse repo empties out completely, which we're thinking maybe around 6 months, there's a likely scenario that short-term borrowing rates skyrocket at that point. And that'll push long-term possibly even higher. Because we're inverted yield curve, but it might stay inverted in a weird situation that's never really happened. The short-term and long-term might both push upward. The Fed may not have any control over the rates at that time, Joe. Can you imagine, all the cash dries up, they're not printing. Let's just say they're not printing next year when the reverse repo empties out, and the short-term interest rates balloon. I mean, the 2-year and the 3-year just start going way up. Well, then you better borrow it now, right? Hey, I don't know what's going to happen in 2 or 3 years. We want to try to make it to 2 or 3 years. If you're looking at this the same way, that the short-term is going to go up when the reverse repo empties, well, then you better get your 2 and 3 year loans now, because the interest rates are just going to balloon upwards. Right, Joe? And maybe 3 years will be okay. Maybe 2 or 3 years, that's when the rates will go down, right? Borrow now. That might be it.
Borrow now, right? And you got to remember, right? Some of these are long term. A lot of these are shorter term, 2 and 3, 5 years, and they're making this assessment and saying, well, we need money, number one, and number two, we don't think waiting another 6 months, 8 months, 10 months, 12 months is going to bear fruit. And then on the other side, another logistics company. So who was it? Was it Yellow that went out? Flexport.
Yep.
In a state of flux, to say the least. They just hired a new CEO. And his first act on the job, this was Friday, they had offer letters out. They had new employees coming in that were going to start on Monday. 75 people were getting ready to start their new jobs. They rescinded their job offers to all of them. In a posting, the company apologized. He says, we're in a hiring freeze. I don't know why we would be adding more people. I hope they will forgive us. But now would not be a good time to add more people and expenses to the company. So, Jason, this is just kind of another sign here of slowdowns. These were companies that were probably betting, well, the second half, things are going to get better. And seemingly, Jason, that has not been the case. And then in the car space, another subprime auto dealership is closing its doors. This is the second major one this year. Off lease only. They're a very popular dealer in Florida. They filed for Chapter 11 bankruptcy, unprecedented changes to the automotive retail landscape. And essentially what they said, Jason, is people just can't afford the car payments, right? And not enough of them. They're spending more time repossessing. And you got to remember, they're in the subprime space. So not only are these the riskiest borrowers, Jason, they also have the highest interest rates. And now they're saying that, hey, you know what? We just can't operate in this environment.
Yeah, I mean, I guess one of the ideas is with green energy, just get one of those driverless vehicles in the future and have it like an Uber and just take you where you're going to go. And that's going to be the future. You don't really need to own a car. But I don't see how being taxied is going to cost you less. Right, Joe? I just think that actually operating the vehicle is going to cost so astronomically high that you're just going to retreat to that. And then I think people are going to have trouble even, hey, anybody's taking an Uber or even a taxi, the longer the trip, the more it costs. So there will be these 15-minute cities and things we keep hearing about. Oh, I can only afford a a 6-mile drive to work, and I live 15 miles away, so you have to move further in. The future looks bleak, Joe, when it comes to affording things that decades and decades of Americans took for granted.
Yeah, when used car, let's face it, we all know that used car, primarily, not everybody. Like, I don't buy new cars. I don't. I buy a used car, but I'm buying a low-mile used car. They're still, they still cost money. Don't get me wrong. But these used car dealerships, right, they cater to the people with the banged-up credit. I mean, that's what they're for. And you used to be able to get these cars $3, $5, $7, and diesel one $10,000. That's gone. You're lucky to find a decent car that doesn't have 250,000 plus miles on it for less than 20,000. Matter of fact, used car prices, which has been one of the things that's helped inflation come down, used car prices just went back up again. And somebody was like, hey, the bottom's in on used car prices. And, of course, we've got the big strike at the end of the week, UAW. Just an update here. They are negotiating. The strike deadline, I want to say, is Friday. The UAW said they wanted a 40% increase. That was over 5 years. Jason, they've lowered their demands. They've lowered their demands to 36%. 18% in year one. 5% in year two. 4% in year three. 5% in year four. 4% in year 5. You tell me how the heck car prices are going to go down when they've got to pay 36% more for labor over the next 5 years, including 18% in year 1. Still no deal, by the way. (800) 951-0592. Joe and Jason, Patriot Radio News Hour. Man, it's just crazy to think. 18% in year 1. By the way, the strike will commence at midnight Thursday. So I'm assuming that means come Friday, 12:01 a.m. Friday morning, the UAW is walking off the job. 146,000 of them will strike if the proper details are not done. And I'm just telling you, how does that make things cheaper? Right? When they talk about letting inflation creep in, and I know Walmart said, hey, we're gonna offer $1 an hour less for these certain jobs. I think that's an indication, right, that things are getting tough. But the UAW is going to want their money, and again, it's going to be a situation where, man, I think this ends pretty badly. I think a lot of people will get fired when it comes, when the slowdown comes. And unfortunately, the prices don't come down, right? Because just the pure cost of things. It's just crazy to think that labor costs are going to jump 36% over a 5-year period. And, of course, the biggest piece of that in year 1. And what that says about inflation, what that says about companies' ability to wait for lower rates to borrow money. I don't think lower rates are coming. Why did we have so many companies that they were investment grade, right? They were investment grade, not high investment grade, but they were investment grade, hitting the debt markets in the last week and a half. I think we've got our answer. And Jason, we talk about banks and what's going on. People need to understand people, I think, have this illusion that there's hundreds of big banks. There's not. And a lot of people don't realize if you took the 15 biggest banks in the country, starts with J.P. Morgan. Right? They've got $3.38 trillion in assets. Of course, they've got like $60 trillion in securities on their balance sheet, if you can go figure. But by the time you get to number 15, They only have $209 billion. That's the last bank that has more than $200 billion in assets. So when we're talking about banks, I know, well, there's 4,000 banks. Jason, there's only 4 that have over $1 trillion. Wells Fargo is 4th at $1.67 trillion. U.S. Bank, they're 5th. Jason, they're only at $670 billion. I mean, so it's a big drop off from Wells to U.S. Bank. But once you get, by the time you get to the 10th largest bank, they don't even have $400 billion. By the 15th largest, Jason, there's not even $200 billion in there. So when we're talking about, hey, the repo banks, the excess cash is running out of money just in office space, just office space. Banks are on the hook for about $250 billion worth of losses. Jason, these kind of losses wipes out the vast majority of the 4,000 banks. I mean, let's face it, we don't even have 100 banks that got $100 billion in assets.
Yep, and all of these numbers always return me back to the FOIA request of what the Fed actually did for 2010, 2008, 2009, which was $29 trillion, right, Joe? Yeah, it was $5 trillion to fix it all. Remember that? It was always the $5 trillion. You had Bush spending money and Obama spending money, but when you looked at it through a FOIA request, there was trillions of dollars going to Japan and other countries. There was trillions of dollars going to the big banks, 1.3 for Citibank, and $2 trillion for Wells Fargo. So all the big banks got a bunch. All the countries that were upside down. People don't really fully realize how big 2008 was. It was the end of the economic system. What's happening now is they're trying to transform it into something. They bought themselves 15 years, apparently, Joe. And so I don't think anyone, I don't even think the guys that are pulling all the levers really know exactly how this thing's going to go down. It could get pretty scary, Joe. This is why you got to protect yourself right now. You got to take, whatever means necessary for whatever you're at in your life to isolate yourself from what's getting ready to happen. I can't say enough how bad it could possibly get over the next 2 years. It just looks obvious that this will be the worst thing that we've seen economically in our lifetimes.
33 banks have $100 billion of assets or more. 33. By the time you get to the 50th biggest bank, you're only talking about $50 billion. That's it. Yeah. By the time you get to the 100th bank, you're talking about a number of 18 billion. We'll round up $19 billion in the 100th largest bank. And by the time you get to bank number 162, Jason, they don't even have $10 billion worth of assets. So when you think about our banking system, 4,000 banks, right? All but 160 of them have less than $10 billion in assets. And the funny part is, $5 billion in assets. There's not even 300 banks that have $5 billion in assets. So when you talk about, remember, right. Janet Yellen was saying how, hey, England only has 300 banks. Well, to get us down, to get rid of 3,700 banks, Jason, we're not talking a whole lot. And, of course, that just means that most of these banks, Jason, one hiccup, and it's all done. One hiccup, and it's all done. I mean, we don't even have 570 banks that have $2 billion worth of assets. That's it. So when we look at this banking system, I don't think people realize how consolidated it is at the very, very top. And you know what? They could give a damn about 3,800, 3,900, really, probably outside of the 33 I don't know that they give a damn about any of the other banks.
Well, a lot of smaller banks are in debt to the bigger banks to begin with. And then on top of that, the biggest banks are closing a bunch of their branches. So it's not like they're isolated from this thing. They're already taking measures ahead of time to start closing their own branches so that they can do better business. So it's the amount. I think I made the prediction because I think banks that went out of business during I think it's 2008 to 2013. I think it was 500 something banks. And I think when the Fed did their numbers last year through quarter three, that there was, I think they said 1,200 banks, either 700 to 1,200 banks were underwater. I would say it's very logical that at least 700 to 1,200 banks are going to be gone out of whatever 4,000 that are left, Joe. At least 700 to 1,200 are going to be gone in the next couple of years. It happened already once. And it could accelerate. You could double that number, Joe.
I'm shocked that people still have money in the bank. It's ridiculous. It's the dumbest thing ever. It's the dumbest place to have your money. If nothing else, call Joey. I mean, at least, first of all, he's got to get you a better return than your bank will, and it's not a bank, and they're AAA rated, and they don't have to worry about things. Most of these banks are toast, period. That's not what I don't want it to be. That's how they want it to be. Look at how it's set up, right? You got the lords, and then all these other banks are just the peasants. Patriot Radio News Hour. I got a great special coming up next. (800-951-0592) Patriot Radio News Hour. Joe and Jason just breaking it down for you. 33 banks have more than $100 billion. And go out to allamericangold.com this morning. Listen to Jamie Dimon cry about the Federal Reserve is making banks that have more than $100 billion put more capital away. Now, part of it I can understand because he's like, that's only 20 more banks, right? It's not that many banks, but there's 33 banks. But again, the amount of stress that is going to be put on banks, let's say banks 10 through 33, has Jamie Dimon freaking out. Why do they got to have more capital? Because they've got so many unrealized losses. I mean, look at the unrealized losses. Over $558 billion. And we know, at the end of the quarter, we're going to be really close to $700 billion again. Remember, that was when the first three banks collapsed. And remember, they were regional banks. These were banks that were in the top 33. Well, a couple of them were. In the top 33. And Jason, all of their assets got taken out of that, and now we're back to that number again. And now, on top of it, a bunch of these banks, you got to have even more money set aside, right? So it's double the pressure out there on these banks, not to mention the banks that are under that number. But I've got an opportunity today, and I mean opportunity. I'll be honest. I'm sure it's happened. It's in my 20 years. I know it has. It has to have. I don't remember when. But this is my favorite coin that the U.S. government has ever minted. We're talking about the $5 Indian. So why is it the favorite? First of all, the design of the $5 Indian is the best, my opinion, because it's the male Indian with the war feathers. I mean, it's a cool looking coin. On top of that, it had what they call an infused design. They've never done it again, which means that they actually etched into the coin. So the coin had grooves in it. And of course, Jason, it was the original pandemic coin. Right? Go back to the Spanish flu. They actually thought the flu was in the grooves of these Indians. So they actually stopped minting them. In 1960, they just stopped minting them. Because they thought that, Eric always used to say That's where the expression, don't put that in your mouth, you don't know where it's been, came from. I don't know. Sounds like a good story. But we know, right, the Indians, they were, when we stopped making the Liberty coins, 1866 to 1907, Teddy Roosevelt, they weren't majestic enough, right? America was a superpower now. We needed cooler stuff. And Augustus St. Gaudens made the $20 gold piece. He also made the $10 Indian. Bella Pratt did the $5 and the $2.50 Indians, right? They're sharp-looking coins. But the Indians carry a huge premium. Why? Well, just because of what I just told you. No, they stopped minting them for years. I want to say the $10 Indian only was minted, I think, for 10 or 11 years. That's it. Total. From 1908 to 1933, they minted them the first 8 years. I think they only minted them 2 or 3 years after that. That was it. And the designs are awesome. I mean, there was a time where a $5 Indian, you're talking about $100 more than a $5 Liberty. Today, and today only, I have 70 $5 Liberties for less. I'm sorry, $5 Indians for less than a $5 Liberty. Today, $5 Liberties are $5.90. 1 through 9 on $5 Indians, $5.85. If you buy 10 or more, $580. Jason, like I said, I'm sure it's happened once or twice before in my 20 years, but you never get Indians, especially the $5 Indians, for less than $5 Liberties, but you're going to be able to do it today and today only. $5.85, 1 through 9, buy 10 or more, $580. And if you want, in my opinion, the best looking coin we've ever minted, this is it.
Yeah, that'll be cool. That's always good to get yourself some gold, no matter how it is. But I have a slightly different opinion of the coins because I'm a follower of the Constitution. We should not have stopped Liberty and the Eagle from being the obverse and reverse of all the coins. I'm not a big Teddy Roosevelt fan. I think things were changing in those early 1900s, Joe. But that aside, I love the St. Gaudens design, and I like the Indian designs. They're cool coins. I have no problem with the designs. I just know that constitutionally, we should have stuck with Liberty and the Eagle. So regardless, here these coins are. They're at the best price. I think we've had them in a while, Joe. I mean, they are on the website to buy, but this is a great price to get these coins at. And what is it in reflection of the $5 Liberty coins? Is about the same price.
So $5 Liberties are $5.90. So you're buying $5 Indians for less. $5 less if you buy 1 through 9. $10 a coin less if you buy 10 of them or more. And like I said, it doesn't happen. It really doesn't. Like today, right now, it's really close. The $5 Indian was only $30 more. $5.90 and $6.20. But look, you can save $40 a coin today on a $5 Indian if you buy 10 or more at 800-951-0592. Jason and I, we're coming right back. $800-951-0592, the $5 Indian special. They're not going to last long. We got one line still open. We only had 70. That is it. 1 through 9, $5.85. That's $5 less than a $5 Liberty. You buy 10 or more, $10 less, $580. You buy 10 or more, you're saving $40 a coin. This is very, very unusual to have Indians for less than Liberties. We have it today, and especially in the $5 Indian. Believe me, you will not be disappointed. If you've never bought especially the $5 Indian, because the $2.50 Indian, same coin, it's just super expensive. Super, super expensive. When you do price per ounce. But you're gonna be like, wow, Joe wasn't lying. This is a nice looking coin for sure. And I want to point out, this was minted only 10 years. One of those years, 1916, They only minted a couple 100,000. I want to say maybe 250,000 of them. That was it that year. Then they stopped minting them. So that was 9 years, 08 to 16. You're like, well, that's 8, but the way you got to count 08 and 16. 9 years, and then only one more year did that coin get minted again, 1929, and that is it. So this is when you talk about limited. This is why usually the premiums are. And I'll tell you this: a year ago, you're talking about paying close to $100 more for a $5 Indian than a $5 Liberty. There's a great value. Not only is gold's low, gold's down $1,917. I mean, that's a steal as it is. But then you get, we don't do, hey, don't buy unless you really know what you're doing, right? The value of these, well, they got, the rare and unusual values and things of that nature. The Indians always have a premium, and so when you can buy it without the premiums, Jason, it's just that much better of a deal.
That's correct. And I can't imagine what these coins will be selling for in late 2024 or 2025. Let's just say that. I mean, the gold prices will go up, and 580 on these coins will be a dream. I mean, what were these coins selling for in 2018 when I showed up? They were probably half this. They're probably $300, right, Joe? Maybe $250.
Yeah, well, maybe $4, right? Something like that.
Maybe.
And it's something where just a great opportunity. We don't run Indians very often as it is, maybe once or twice a year. And again, it's really the value play here right now. We got CPI coming out tomorrow. They're bracing us for a bigger number. I don't think it's going to matter. I think the Fed, this is how stubborn these guys are. I don't know that they're going to be raising rates next Wednesday. And if they don't, I wouldn't be surprised to see gold run if they don't because of that. But everybody's still saying one more, Jason. I don't know how we get away with just one more. Look at what we're talking about today. I mean, UAW, hey, we want an 18% raise this year. And by the way, another 18% over the next 4 years. I mean, it's insanity.
We'll see how the numbers come in because they want to do their decisions on what the information is. And I think their information in October, November, December this year, we'll see what their numbers are in those months because if it goes where I think it's going to go, I think inflation, it looks bad.
Yeah, instead of a big fall off, are we going to have big jumps? Yeah, that could be. 800-951-0592. Jason and I are coming right back with the half empty cup. Stay with us.